Commercial real estate leases are long-term commitments with a lot of legal language that can materially impact the economics of an entire real estate deal. And with many of these leases having terms of 5, 10, 15 years or more in some cases, making sure you understand all parts of a lease agreement is extremely important when buying commercial properties or signing a new lease on a property in your portfolio. So if you're not as familiar with commercial leases as you'd like to be, or you just want to make sure you have the big ticket items covered before getting into the industry, in this video we'll cover 4 of the most important things that you need to know about commercial real estate leases and why each of these things is so important to the cash flows and returns of a commercial real estate deal. So the first thing to note here tends to be especially applicable on retail leases specifically, and this is that some commercial lease clauses can make a tenant's rent payments contingent on the performance of that tenant or even other tenants at the property, and can also sometimes prevent a property owner from signing new leases at the site in some cases. Some retail leases will include what are referred to as exclusivity clauses, which essentially grant a tenant the right to be the only occupier of the property that engages in a particular type of business or sells a certain type of merchandise, and this can end up being extremely restrictive for the landlord and can completely tie your hands, even in cases where you may desperately need to sign a lease just to keep the property afloat. Co-tenancy clauses are also important to look out for in retail deals, which usually allow a tenant to either pay a reduced rental rate or no rent at all for a period of time if another tenant at the property that they rely on for foot traffic ends up vacating or going dark, which can make what may already be a very difficult financial situation for a property owner even worse and can ultimately cause a domino effect of rent losses at the worst possible times. Now, performance-based rent isn't always a negative thing, and this can end up going both ways, and percentage rent clauses on retail leases can be a huge benefit to property owners when market conditions are strong. These structures won't reduce the amount of rent a tenant is required to pay, but instead, these actually allow a property owner to participate in a portion of the sales a tenant generates over a predetermined breakpoint amount, which helps align the interests of the owner and the tenant in a really big way. Exclusivity clauses, co-tenancy clauses, and percentage rent clauses are 3 of the most common examples of this, but ultimately, unlike residential leases that won't fluctuate based on a tenant's income and won't be dependent on other tenants that occupy or vacate the property, commercial leases can be very dependent on the performance and the operations of the entire property as a whole, and it's really important to get clear on how this might come into play before going into a deal. Now, the next thing to keep in mind about commercial leases is that also, unlike residential leases that are usually going to stay flat throughout the entire lease term, commercial leases often include scheduled rent escalations with base rent changing at predetermined intervals. Many commercial leases have multi-year terms, with some leases spanning 25, 50, or even 75 years or more in some cases, and with that, the rents in these leases will almost never stay flat throughout the entire lease term. And to make sure the details of these increases are made very clear up front, most commercial leases are going to include what's referred to as a rent escalation schedule directly within the lease document itself, specifying exactly what the rent is going to be at each individual escalation and when each of these increases is scheduled to occur. Sometimes these will include annual percentage increases, sometimes these will include fixed dollar amount increases, sometimes these will include larger, more irregular increases every 5 or 10 years, or these might also be tied to changes in the consumer price index to protect the property owner against rising costs in an inflationary environment. Commercial leases also often include tenant options to renew, which gives a tenant an exclusive option to renew their lease at the end of the lease term, usually in 5 or 10-year intervals at predetermined rates. These rates are often based on what's referred to as fair market value, which represents the rate at which the property owner could re-lease the space when the lease expires if the tenant were to vacate the property and choose not to exercise their option. And to make sure the property owner is protected in the case that rental rates actually drop during the lease term, renewal option rents will often be calculated as the maximum value between the fair market rent of the space at the time of renewal, or something like 90 to 95% of the base rent owed in the last year of the lease term. And speaking of tenants deciding to renew their leases, this is also one of the most important aspects of owning and operating commercial real estate successfully, which leads into the next point on this list, which is that lease-up costs when a suite becomes vacant can have massive impacts on commercial real estate cash flows and returns. Retail, office, and industrial leases often come with two really big lease-up costs that can significantly impact the economics of a deal, which are tenant improvement allowances and leasing commissions, and these can be huge cash outlays for investors when a new lease is signed. Tenant improvement or TI allowances are allowances that are made by the landlord to essentially reimburse the tenant for a portion of the build-out costs required to get the space ready for operation, and these are usually used to incentivize a tenant to sign a long-term lease by reducing the upfront capital investment required and by showing that the property owner is invested in their success. TI allowances are often expressed on a dollar per square foot basis, and I've seen these range anywhere from about $5 a foot for big spaces that don't need a lot of work to over $100 per square foot for smaller spaces that need to be almost completely repurposed. And when you start to run the math on this, TIs, even for a very small commercial suite, can start to get expensive very, very quickly. And in addition to TI allowances, leasing commissions can also be huge expenses for investors, since these are generally based on a percentage of the contractual base rent owed during the entire lease term. And with 10 to 15 year leases being common in the commercial real estate industry, and commission percentages that usually range anywhere from about 3% and 6% of the total contractual base rent on the lease, these costs can often end up being even bigger cash outlays for commercial real estate investors. When you hear someone in the industry talking about office or retail being capital intensive parts of the business, this is usually what they're referring to, and understanding when you'll have to incur these costs and how much these are likely to be are extremely important parts of underwriting a deal and dialing in your numbers. Now, the last point I want to make in this video about commercial real estate leases is related to what happens after a lease is initially signed, and this is that commercial leases will often call for tenants to be responsible for their pro rata share of some or all of the operating expense load on a commercial real estate deal. Unlike residential leases, which usually only call for tenants to pay their own utilities or trash bills, commercial leases will often require a tenant to pay a portion of the total operating costs associated with the entire property as a whole, usually in relation to the specific percentage of the leasable area that each tenant occupies. Some of the most common expense reimbursement structures you'll see in commercial leases include triple net structures, where the tenant is responsible for their pro rata share of all operating expenses at a property, modified gross structures, where the tenant is responsible for their pro rata share of only certain operating expenses associated with the site, and base year stop structures, where a tenant is going to be responsible for their pro rata share of any overage above a designated base year expense amount. And usually the structure that's going to be used is going to be decided mostly based on whatever the standard leasing practice is in the specific market the property is located within, so investors won't always get to start the negotiation with the most advantageous structure to their bottom line financials. With that said though, at the end of the day, a lot of these structures end up coming out almost the same for an investor financially, with the tenant essentially baking in these estimated costs when making their initial offers regarding base rent. Even though triple net structures do put the operating expense load directly on the tenant, in many cases, these operating expense reimbursements are going to be factored into the negotiations when a tenant is trying to figure out what they're able and willing to pay in base rent specifically, meaning that in the case of a triple net or modified gross reimbursement structure that might seem more beneficial on the surface, these additional costs are often already backed out of a base rent figure that the tenant is willing to pay. Ultimately, commercial real estate leases can be really complex, and there are a lot of things to look out for and to factor into your underwriting. And if you want to learn more about commercial lease structures and how to model these in Excel when analyzing and valuing commercial real estate deals, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on commercial real estate lease structures, make sure to hit the like button and let me know. And let me know in the comments any other commercial lease terms that you'd like to see covered in more detail in a future video, or any terms that you wish you would have known before getting started in the commercial real estate industry. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.